Hello my fellow investors and welcome back to another stock recommendations video. And yes guys, I am going back to this because, well, earnings are kind of subsiding. Don't get me wrong, there's still lots of earnings to cover, but none of the companies that are having earnings rather recently is anything I want to actually cover. So let's actually start taking down some of the recommendations that you guys have asked, because it has been several weeks. So we're gonna start off, guys, with the company PotlatchDeltic. Okay, I have no idea how to say that, and I'm not going to say it again. But this company was brought up by Tony Myers right here, and you can see I do plan on doing 3 companies in this video, 2 by Tony and 1 by Chad, sweet name by the way, CNI. So you're going to have 3 different companies in this video. We're going to knock all of these out today. And of course, we're going to start off with this one, the one that I just butchered its name. So let's start off, guys, with this analysis. So let's cover exactly what this company actually does. Is a leading real estate investment trust that owns 1.8 million acres of timberland in Alabama, Arkansas, Idaho, Louisiana, Minnesota, and Mississippi. Like all of those states, by the way, not gonna lie. Throughout its taxable REIT subsidiary, the company operates 6 sawmills, an industrial grade plywood mill, a residential commercial real estate development business, and a rural timberland sales program. That company is a leader in sustainable forest management, is committed to environmental and social responsibility, and to responsible governance. Basically, guys, they are a timber company. And of course, always remember that any company that mines, that refines, that has anything related to a certain commodity, it will most likely follow that commodity as it trends either up or down. And, well, they're a timber company, guys, right? So that means that they're going to follow the lumber futures. As you can see, lumber has been going steadily down for about a year now. I mean, lumber prices went significantly up right here, right at the peak of 2022. Remember that? It was absolutely insane. But so far on the 1 year, they have collapsed 66.77%. And on the year to date, they're actually up almost 11%. Now, looking specifically into this company, however, they did have earnings on the 30th of January of this year. EPS normalized actual came in at 12 cents, missed by 5 cents. EPS GAAP actual came in at 5 cents, missed by 12 cents. Revenue, $253.14 million, which is beat by $10.23 million. And here is their quarterly earnings. Now, I'm going to go through this rather quickly because there are 3 different companies I want to cover. So let's just take a look at the highlights. And of course, like always, this will be linked in the description below if you guys would like to read all of it. You can see it is very lengthy. So let's get started with these highlights. 2022 highlights generated total adjusted EBITDA of $574 million and total adjusted EBITDA margin of 43%. Acquired Catchmark Timber Trust Inc., adding nearly 350,000 acres of superior site index southern timberlands. Okay, so they made an acquisition. So get ready to see that possibly like in their debts. Also acquired 46,000 acres of well-stocked timberland in 3 bolt-on transaction, announced $131 million expansion and modernization of Waldo, Arkansas sawmill, rebuilt and reinstated a large log line at the Ola, Arkansas sawmill, returned $280 million to shareholders through regulated dividends, and a Q4 special dividend. Very nice. We're gonna take a look at that, and after when we go into the dividends. Very interesting. Repurchased 1.2 million shares for $55 million or $45 per share. I love that. I love when companies actually say, hey, we bought these many shares for this amount of money and this was the average share price. I really like to see that. And maintaining strong liquidity positions of $343 million as of December 31st, 2022. And here we have a quote from the CEO. Each of our businesses delivered exceptional results in 2022, leading to our 2nd highest total adjusted EBITDA on record and marking our 3rd straight year of very strong financial performance, said Eric Kremers, President and CEO. 2022 was also a very active year for successfully deploying capital, including acquiring nearly 400,000 acres of high-quality timberland and committing to expand and modernize our Waldo, Arkansas sawmill. Additionally, we returned $263 million to shareholders, as we just read, including 55 million shares of repurchases and $76 million special dividend. With our disciplined capital allocation strategy and our strong balance sheet liquidity, we are well positioned to continue increasing shareholder value. Guys, All of that sounds really, really good. Now, let's compare some of these numbers to, well, Q4 of 2021 as well as Q3 of 2022. Now, looking at the revenue, we got here Q4 of 2022, $243 million compared to $248.4 million in Q4 of 2021. That is an increase, but take a look at this. They actually came down from Q3 of 2022 to Q4 by around like $50 million or so. That's a significant amount, guys. Net income pretty much, well, actually, no, never mind. Net income, I was going to say pretty much did the same thing. No, net income was really bad. $3.8 million Q4 of 2022. Q3 of 2022, $46 million. Q4 of 2021, $39.2 million. Massive, massive decrease. Looking at the net income per diluted shares, you can see it was 64 cents in Q3 of 2022 and 58 cents in Q4 of 2021. Q4 2022, guys, 5 cents. That's a massive decrease as well. Now, something very, very interesting about this is that, well, we saw a lot, especially up here, that they were talking about their EBITDA. So let's actually take a look at that in a much further sense, because it's actually really, really interesting, especially when it comes to analyzing this company. Now, looking at their adjusted net income per diluted share, you can see it was also a massive drop, 74 cents Q3 of 2022, 59 cents Q4 of 2021, and 12 cents of Q4 of 2022. Their adjusted EBITDA, though, take a look at this, $101 million Q3 of 2022, $75.7 million of Q4 2021, all the way down to $52.3 million of Q4 2022. Guys, that's a massive, massive decrease, especially from quarter over quarter, right? Quarter over quarter was bad, and year over year, it was also pretty bad. Dividends have actually been all over the place. They raised their dividend from Q3 to Q4, but they dropped it from Q4 2021 to Q4 of 2022. Interesting. However, remember that they did give out a special dividend. In fact, right here, the regulated dividend was increased 2.3% to 45 cents per quarter in Q4 2022, and a special dividend of 95 cents and $4 per share was paid in Q4 2022 and 2021 respectively. So, you know, I think they do have a tendency to give out that special dividend. I don't know, this is the first time I'm looking at this company, but from this looking like, they do tend out to give a very special dividend at the end of the year. So really, really interesting to see. So now let us jump into the calculator. This is the revaluation calculator, and well, this is a REIT company, so we have to use this one. We can't use discounted free cash flow. This company does not have capital expenditures. However, unfortunately, you guys are looking at this and you're like, there's some numbers missing here. Yeah, there are some numbers missing here. It's because, well, guys, even though this is a REIT, I could not find their funds from operations or adjusted funds from operations. So that's a problem. I do not know where to find them. I tried looking for them. I tried looking in different third-party sites, Seeking Alpha, Yahoo Finance. I tried looking into like their financials. Even if you were to take a look at like, you know, their quarterly earnings, if I were to do like Control F and hit like FFO up here, the only thing that comes up is affordability. That's it. Nothing else. So I do not know exactly how they do their FFO. And again, if we take a look at this, we do see that they are a REIT, that they're a specialized REIT. So I do not know exactly where to find this information. So for this case, I'm not going to put any numbers, so we're going to have to skip on this, and unfortunately, we can't really do an analysis based off of the funds from operations and adjusted funds from operations. So we're only going to do net asset value, but nonetheless, we got the ticker symbol for PCH, market cap of almost $4 billion, a current share price of almost $48. Now looking at this on the 1 year, they're down almost 9.2%. Year to date, they're probably up. Yeah, they're up 9.29%. 52-week range is $38.26 to $56.89. Now, as you can see, we are pretty much smack in the middle between these 52-week ranges when it comes to this. So don't really know where to actually place this at the current moment. And as I just said, they do not have an FFO and AFFO. However, they do pay out a dividend of $1.80. And this is a yield of 3.77%, a payout ratio of 35.61%, a 5-year CAGR, actually the 5-year CAGR isn't too big, 3.02%, 3 consecutive years of dividend payment, and ex-dividend date passed as of December 13th, payout date was on the 30th, and they pay their dividends quarterly. And we did see that they did mention a special dividend in the 4th quarter. And we do see that they sometimes pay out a special dividend. You guys can see right here, they mentioned 95 cents. Yep, there it is right there. If I can get my mouse over it, right there. On December 19, 2022, they paid out 95 cents. They also did the same thing in 2021 for $4. And the only other time that they did that was in 2018 for $3.54. So it's not really consistent. Yeah, I don't really know what to say about that. Though, to be fair, the one in 2021 was probably because, I mean, everybody knows what happened in 2021 with lumber prices, right? Everything just shot up massively. Now, based off of the current shares outstanding and this $1.80 in annual dividends, they pay out $143.46 million every single year. Now, unfortunately, we do not have these payout ratios, so we're going to have to move on into the fundamentals. So looking at the net income, guys, we got 5 years ago of $123 million to today of $333.9 million. Let's say 334. That is an increase of 172%. And you could definitely tell. Wait, could you guys tell when lumber prices rose? I'm just based off of this net income, could you figure that out? If you guessed right here, you'd be right. So it just goes to show that it really does matter as to what commodity, as to what the commodity of the certain company actually does. Because there you go, right? You see it right there. They were falling from 5 to 4, then they jumped 3 years ago during COVID, slight jump, and then the following year when things really hit the fan and just like inflation rose, there was massive demand for housing and all this stuff, boom, $424 million. As of 1 year ago, they've come down, right? Demand has somewhat fallen, so not surprising that they came down. Overall, I'm giving this a 60%, mainly because massive spikes. The spikes are understandable though, but it's still a spike, so 60%. Now, we don't have any data, as I said, for the funds from operations and the AFFO, so we'll skip these for now, and we're gonna go into the assets minus liabilities. This was actually a surprise because this actually isn't looking too bad. They were in the positive in the past 5 years. They had a pretty big spike from 2 to 1 year ago, but aside from that, it really isn't looking too bad. And, you know, they went down from 5 to 4 years ago, but we saw the same thing in the net income, so you know, it's not that bad in my personal opinion. Average total assets, it is $2.76 billion. Average liabilities is $1.65 billion. And doing this difference, we get $1.1 billion. I give this a 70%. Looking now at the shares outstanding. This one, okay, so when it comes to REITs, and I always say this every time because I don't cover REITs a lot. So if anybody is watching this for the first time, you're like, I have no idea, you know, this is my first time seeing a REIT and all this stuff. Actually, it was a commenter in my previous video that commented about the shares outstanding when it comes to REITs. REITs tend to issue shares. That's just the way that they do. The way that you want to analyze this is, and I really do need to figure out a better way to, like, I guess, assess this. But if they're increasing shares at a lower rate than what they're actually giving back to you in the form of FFO, AFFO, net income, then it's kind of justified. So looking at this, we got 5 years ago of 67.6 million shares to today of 79.7 million shares. That is only an increase of 18% in the past 5 years. There are other REITs out there that give this a lot higher, like significantly higher. So for that reason, I'm giving this a 100% because, I mean, 18% in 5 years, guys, not a lot. If you take a look at this graph, most of this happened just 1 year ago. So, you know, take it with a grain of salt as it is. And on top of that, remember that they did buy back shares. At least in the quarter, they bought back shares. Maybe in the year they issued, but in that fourth quarter of 2022, they did buy back shares. So I'm giving this a 100%. Again, you guys can think different, but for me, 18% 5 years is not a lot, so 100%. And looking at the total debt, well, we don't really do anything with this. I just mainly like it because I want to see their total debt. You can see that they've kept it the same. This is incredible. Like, they've kept it roughly the same. In fact, on the 5 years, only an increase of 1%. That's amazing. That's absolutely amazing. And you can even tell right here that when things were really hitting the fan, like when the lumber prices were skyrocketing, they were just lowering their debt, which is hilarious. So that's actually really, really good to see. 1% increase in debt, guys, is nothing. In 5 years, that's nothing. So now let's take a look at the overall grades. For the net income, we give it a 60%. Nothing for the FFO, nothing for the AFFO. Assets minus liabilities, 70%. The shares outstanding of 100%. This is a 34, but then again, I don't know because we don't have that FFO and AFFO data. If anybody knows, Tony, if you know, please, you know, use the calculator and, you know, see what number you get. And if you don't mind putting in the comment section, that'd be great too. But as it currently stands, I have no data. I can't really do anything about it. So it is what it is. And now, unfortunately, looking at the valuation, we really can't do the price divided by FFO or the average price divided by FFO. So the only thing that we can do, guys, is the net asset value. Very, very simple. We take the assets minus the liabilities divided by the current shares outstanding. Boom, we get the net asset value for the company. Now, at the current share price, this is almost $48. And the net asset value, it is $28.40. So unfortunately, it is looking a bit expensive. Right? It is looking a bit expensive. However, if y'all remember the 52-week range, well, it was $38.26 not too long ago. So maybe if we would have taken a look at this company back then when it was like around like the $38 mark, it, you know, I guess we could say $28 to $38, a $10 premium. It's not really that bad. I guess you could say, right? A $10 premium is not really that bad. Obviously, that would depend on you. But as it currently stands at $48, you know, that's a $20 difference, guys. That, I don't know. And on top of that, we don't have the FFO. I really can't make a determination when it comes to this company. I'm terribly sorry, but I just can't do it. I physically can't do it. So this is a company that I would just be like, skip, because I just don't understand it. I physically don't. So it is what it is. If anybody knows, please let me know in the comment section below. So please, this is why I have all of these calculators available for free for that reason. This is not financial advice. Every investment is a present value of all future cash flow. And that's the reason why, again, I have them all for free. Please use them to your own discretion. The link is in the description below. Have them for free. All I ask for in return, guys, is like, subscribe, comment. It really does help her with the algorithm on YouTube. Guys, we're above 2,000 subscribers. As if I'm recording this, it is at 2017. Y'all are crazy. Insane. And tomorrow on CPI, well, tomorrow, when you guys see this, you'll see this at 4 p.m. on the 14th. Happy Valentine's Day, by the way. On the 14th of February, that night at around 7 p.m. I will, or I guess this night at around 7 p.m. I will have a live stream for CPI, and I'm gonna live stream this with my co-host, you know, the boy, the one that makes technical analysis videos, and I would like to essentially do a rundown of CPI, but also provide a channel update and the future for the channel as well. All positives, there are no negatives. So I really would like to do that, where I would like to take the channel in the future. And because I really would like to make this a business. I really would. Like, I really would. And I would just like to tell everybody exactly like how I plan, at least what my aspirations are. So if you guys are down to that, stop by. It'll be at 7 p.m. Eastern. And I'll also be taking, well, I guess we'll also be taking some AMAs, Ask Me Anything. So if you guys have any questions for us, if you guys want to take a look at some companies through a technical analysis or fundamental analysis perspective, we can do that too. We'll stay live as long as we can, or as long as we have to. If we see that we're not getting any interaction, then we'll just leave. Like, we'll just end it like as soon as we're done talking. But if we see a lot of interaction, then we'll stay on for a little bit longer if people want to do so. So yeah, stop by. It'll be at 7 p.m. Eastern Standard tomorrow on the 14th. Let's see. Stop by. Ask us anything. You know, see what the channel's going on. See what's going to happen with the channel, and tell me if you guys have any feedback on that. Now, I'm not going to say that for the next two companies that we're going to take a look at. So I'm just going to say it right now. And now let's actually take a look at this company's dividends, because with $1.80 putting in $5,725, this nets us an annual dividends of actually pretty good, $214.79 in annual dividends, quarterly dividends of $53.70, monthly of $17.90, and on top of that, you're also getting the occasional special dividend. So it may be pretty good when it comes to dividend perspective, right? REITs are normally forced to pay out like 90% of their payout ratio in the form of a dividend. Now, this is a specialized REIT. I do not know exactly what their regulations are, but that's what a normal REIT usually does. So it is what it is. $215 essentially, not too shabby. All in all, my issue with this company is just that I don't know their FFO, or even if they have an FFO, right? So based off of that, it makes it a little bit difficult to analyze it. But with that said, let's jump over now into the second company. So now with that said, let's jump into now the second company, guys, which is, oh boy, Weyerhaueuser. I think that's the way you say it. This one's a little bit less complicated than the other one. But again, Tony Myers, you recommended this one, and Well, to my surprise, this is actually another timber company. So let's take a look at what this company has to offer. And of course, let's start with the company profile. Weyerhaueuser Company, one of the world's largest private owners of timberland, began operating since the 1900s. We own or control approximately 11 million acres of 11 million acres, Jesus Christ, of timberland in the United States and manage additional timberlands under long-term licenses in Canada. We manage these timberlands on a sustainable basis in compliance with international recognized forestry standards. We're also one of the largest manufacturers of wood products in North America. Our company is a real estate investment trust. In 2020, we generated $7.5 billion in net sales. That's not surprising. And employed approximately 9,400 people who serve customers worldwide. So right then there, guys, we have another company that has to do with timber, right? That has to do with lumber. So we're probably going to see similar applications to what we just saw with the other one when it comes into specifically their profit metrics. Now, looking at their earnings, they had their earnings on January 26 of 2023. EPS normalized actual came in at 24 cents, beat by 6 cents. GAAP actual came in at 2 cents, missed by 16 cents. Revenue $1.82 billion, so much bigger than the other one that we just had. However, though, this was a miss by $96.53 million. Now, unlike the other one, unfortunately, their earnings, you actually have to download. So I'm just going to leave you guys this page over here. You guys just come over here to whichever earnings you want. The most recent one would be this one, Q4 fiscal year 2022. So you click on that one, you download it, and then you read it. And this will essentially lead you to this. So let's actually get started with this. Now, this is really long. I am not going to read this whole entire thing, but they do highlight their main things right here at the beginning. We got Weyerhaueuser reports fourth quarter full year results, generated full year net sales earnings of $1.9 billion or $2.53 per diluted share, achieved a full year adjusted EBITDA of $3.7 billion, returning $1.75 billion in total cash back to shareholders based on 2022 results, including $550 million of share repurchases completed in 2022. And by the way, that actually came in as a surprise. When I show you guys the shares outstanding on a 5-year view, you're going to be like, what? It's actually really rare. This is the first time I've ever seen that happen. So we're going to take a look at that in just 1 second. Now, before I actually read what the CEO has to say, take a look at this paragraph right above that. This afternoon, the company declared a 90-cent per share supplement dividend. On a combined basis, including dividends and share repurchases, the company is returning $1.75 billion of cash, or 75% of 2022 adjusted FAD. I do not know what FAD is actually. That's the first time I'm seeing that. To shareholders based on 2022 results. So right then and there, 75% of their adjusted FAD is going into the shareholders. Really, really nice. Okay, now a quote from the CEO. I am extremely proud of our accomplishments in 2022, and our performance reflects strong execution across all businesses despite macroeconomic headwinds, supply chain disruptions, and dynamic market conditions, said Devin W. Stockfish, President and Chief Executive Officer. Our teams drove continued improvement across each of the valued levers of our investment thesis in 2022. Notably, we grew our timberland holdings through a strategic acquisition in the Carolinas, captured additional operational excellence improvements, announced our first 2 carbon captures and storage agreements, and joined the Climate Pledge. We also increased our base dividends by 5.9%. We purchased $550 million of our shares and refinanced $900 million of our debt. Entering 2023, our balance sheet is exceptionally strong, and we are well positioned to navigate through a range of market conditions. We remain focused on serving our customers and driving a long-term value to our shareholders, and so on and so on and so on. So not too bad. They are looking like, well, they're seeing that they are in a well-positioned state. So we'll see how that turns out. Now let's come over here into their finances. We got net sales in 2022. This is actually a little bit weird of how they do it. Okay, so Q4 of 2022, $1.8 billion. Q3 of 2022, $2.3 billion. So that was a drop, right? That was a drop from Q3 to Q4 of the same year. Now that was actually roughly the same drop from 2021 Q4 to 2022 Q4, going from 2.21 billion to again 1.8 billion. On the full year of 2022, net sales was $10.2 billion. However, take a look at this. In 2021, it was $10.2 billion. That's a little bit of a change right there, guys. They did go down even on the full year. Net earnings $310 million Q3 of 2022. Q4 $11 million, so that was a drop, and it was a bigger drop from Q4 2021, $416 million. Looking at now their net earnings per diluted share, 42 cents Q3 of 2022, 2 cents Q4 of 2022, and 55 cents Q4 of 2021. Looking at their adjusted EBITDA, it was also another big drop. Q3 of 2022, 583 million. Q4 of 2021, 674, and last quarter, Q4 of 2022, $369 million. And even on the year, that was still another drop by around $500 million or so. So as you can see, guys, they are coming down a little bit here and there, mainly because probably they are tied to the price of lumber. So it is what it is. And now let's actually come over here into the calculator. Now, the same thing that you guys saw with the other one, we're seeing with this one. They do not have FFO or AFFO. I think that this is a trend among timber REITs, I think. I'm not sure, but, you know, 2 out of 2, they don't have FFO and AFFO. I think that they just don't have this. So can't really do anything with this. But nonetheless, we got the ticker symbol for Wyoming. Just kidding. WY. We got the market cap of $25.1 billion, a current share of $34.20. So far this year, they're down 13.4%. Year to date, they are up almost 11%. 52-week range is, again, similar to the other one, smack in the middle. Lowest, it is $27.37 to $42.86. Of course, we do not have FFO and AFFO. However, they do pay the dividend of 76 cents, which is a yield of 2.26%, payout ratio of 23.76%, a 5-year CAGR of -0.45, 1 year of consecutive growth when it comes to dividend. Ex-dividend day is actually on March 2nd. Payout day is going to be March 17th, and they pay their dividends quarterly. Now, let's come over here and take a look at their dividend history to see what we can find out when it comes to this. And yeah, that's probably, well, I don't, this is kind of weird. I'm gonna have to take a much longer look at this to actually see what's going on here. But you can see that they stopped issuing a dividend as soon as the whole COVID pandemic started to happen, right? They skipped here, and then they only issued it back as of December 2nd, 2020. But from what it's looking like, let's see, they paid 1 in 2021, another 1, 2, 3, and they probably did a special one right there, and 4. So yeah, I mean, ever since 2021, they have, I guess, continued it. It's not like, you know, they stopped it for a little bit of time in 2020, but they still paid it in 2020. Like, they didn't miss a year. That's what I'm trying to say. But it's pretty much all over the place, in my personal opinion, when it comes to this. Nonetheless, though, based off of the current shares outstanding, they pay out 556, well, let's just bring it up to $557 million every single year in dividends. And of course, we don't got the payout ratios because we don't have an FFO or AFFO. So now let's actually come over here and take a look at the fundamentals, starting of course with the net income. 5 years ago of $748 million to today of $1.9 billion, increase of 151%. Big elephant in the room here is they went negative 4 years ago. 4 years ago was not COVID related, so what happened here? I have no clue. And on top of that, well, we do see a massive spike 2 years ago, but that was perfectly understandable. So the main issue is, why did they go negative this year? Definitely something to find out. Overall, I'm gonna have to give this, well, unfortunately, I'm gonna have to give this like a 40% because that's, I do not know why they went negative 4 years ago. Now, they don't have either one of these, so we're just going to skip. Looking at now the assets minus the liabilities. This one is actually looking really good. Let's take a look at this. Within the past 5 years, they have been positive, and they did go down slightly from 2 to 1 year ago, but it's not that bad in my personal opinion, right? And the spike here from 3 to 2 years ago wasn't that much, going from 8.7 billion to 10.7 billion, only an increase of around $2 billion or so. Average total assets, it is $17 billion. Average liabilities is $9.7 billion. Doing this difference, we get almost $7.35 billion. I have this as a 70. I'm actually going to increase this slightly to like an 80% because I actually really do like this assets minus liabilities. So it is what it is. Now, into the shares outstanding. This one caught me by surprise because you guys just heard me say in the last company, hey, REITs usually issue shares, right? Take a look at this. They're buying back shares. They are buying back shares. Not a lot, but they're buying back shares. Take a look at this. 746.4 million shares to today of 732.8 million shares. Decrease of 2%. Guys, that's 100%. Like, this is the first time I've ever seen a REIT buying back shares. So right then and there, you know, I'm taking this as a win, and I'm giving it 100%. Absolutely gorgeous. And it actually continues, because take a look at this debt. They're decreasing their debt 24% in the past 5 years. $6.65 billion worth of debt to $5.1 billion. Guys, that's rare. And the less debt a company has, the better they are. So yeah, this is actually looking really, really good overall. If I had to give the debt a grade, 100%. 100%. 100%, I would give the debt 100%. There you go. That's what I meant to say. So that's actually looking really, really good. And now taking a look at the overall grades, we give the income 40%, assets minus liabilities 80%, shares outstanding of 100%, total grade of 31. Now, 31 lower than the other one. However, guys, we don't have the data for these two, so it is what it is. But just because the debt is coming down and the fact that they're buying back shares, I would add honestly, I would add another 40% to this, because that is so rare to see. And yeah, that would actually put this company at 71%. Me personally, I would just ignore these two because I have no idea where they are. Net income, figure out why they went negative, but it was 4 years ago also. They probably trended with the price of lumber. If that's the case, then the net income that you guys might put for a grade might be significantly higher. In my personal opinion, the fact that they're buying back shares and that they're lowering their debt gives them an automatic 40% off the bat. So yeah, it says 31. Me personally, make that 3 a 7, and we're pretty much good when it comes to this company. And now looking at the valuation, well, guys, at $34.20, doing now the net asset value, because again, unfortunately, we don't have price divided by FFO, we get a share price of $14.67. Yeah, it's expensive as well. The lowest point was at around 27. I guess you could make the same kind of assessment that you might have been willing to buy it at that price. And again, it's really up to you. But honestly, just the fact that they're buying back shares and they're lowering their debt, I would personally take that premium of $20. That's just me. This is me personally. But that's so rare, and I actually kind of like that. So do with this information as you will. Obviously, if you know anything about the FFO or AFFO, please use the calculator and make your own assumptions, and then maybe you'll get to see a lot more than what we have here in this video. But it is what it is. It is looking expensive as it currently stands. And of course, taking a look at this from a dividend perspective, if you were to put in $5,725, this would net you an annual dividends of $127.23. A little bit lower, but then again, you are getting a lot more upside, seeing that, I'm going to keep saying this, they're buying back shares as a REIT, and they're also lowering their debts. All in all, not bad. I would actually, out of the two lumber companies or timber companies, I would actually prefer this one, honestly. Both of them are still missing the FFO, so it is what it is. But just from the shares outstanding being bought back and lowering their debt, I prefer this one a lot better. Now, let's jump into a company that is not a REIT company. Alright guys, now for the third company. This one was brought up by none other than Chad Ferreira. However, he actually did not recommend this company. What he did recommend was for me to do more Canadian stocks. And I just added CNI to the list because I'm that's the only, that's one of the two Canadian stocks I know. So I figured, you know what, let's actually do this company as well. So let's take a look at Canadian National Railway and see what we can learn from their earnings report. Now, they had earnings, guys, on the 24th of January. EPS normalized actual came in at $1.57, beat by 2 cents. EPS GAAP actual came in at $1.57, beat by 1 penny. Revenue, $3.4 billion, which was a beat by $49.42 million. And unfortunately, when it comes into this company's earnings, well, you guys have to do the exact same thing as you did for the company Weyerhaueuser, the one that was the ticker WY. You have to go in here and actually download it. I can't just send you the PDF link because the PDF link involves a download link. So I'll give you guys this, and then you guys could download it. But this will lead you to this website over here. So now, or not this website, sorry, this PDF, which it is CN announces fourth quarter end of year results. We got over here, guys. Well, actually, the first thing that we got, it is the CEO statements. So we got over here, I'm very proud of the work accomplished by our team in the fourth quarter and throughout the year. Our approach to scheduled railroading improved our service to our customers, drove operational efficiency, and built the resilience that enabled a rapid recovery during the extreme winter conditions late in the quarter. As we look to 2023, we believe our back-to-basic strategy and disciplined operating model will continue to deliver despite the softening economy. All right. Remember, these guys are in Canada, so every single number they're going to see here is in Canadian dollars. However, in the calculator, it is changed to US dollars. Nonetheless, though, got over here, financial fourth quarter highlights: revenues of $4.54 billion, which was an increase by $789 million or 21%. Operating income of almost $2 billion, an increase of 22% or an increase of 21% on an adjusted basis. Diluted EPS of $2.10, increase of 24% or an increase of 23% on an adjusted basis. An operating ratio defined as operating expenses as a percentage of revenues of 57.9%, an improvement of 0.4 points or remained flat on an adjusted basis. When it comes to the full year, all these numbers just get bigger. Revenues of $17 billion, increase of $2.6 billion or 18%. Operating income $6.8 billion, an increase of 22%. Diluted EPS of $7.44, increase of 8%. Operating ratio of 60%, improvement by 1.2 points. Free cash flow, like this, of $4.3 billion compared to $3.3 billion in 2021. So that was a pretty big increase, right? That was about like $1 billion. Yeah, $1 billion in a year. That's really, really good. Return on invested capital, ROIC, really, really important. This is something I don't cover though, but this is one of the most, well, actually, I would argue that this is what you would consider in order to see, hey, am I willing to pay the premium for this company if it is overvalued? A high return on invested capital means that you might be willing to put in a little bit more of a premium, assuming that it is above the target share prices. Nonetheless, though, the ROIC, 15.8%, decrease of 0.6 points, and adjusted ROIC of 15.9%, increase of 1.8 points. So really, really interesting. So over here, let's actually take a look at the 2023 outlook. CN expects to deliver EPS growth in the low single digits range due to softer economic outlook. Whoa, they just came out and said it. The economic board of directors approved 8% increase to CN's 2023 quarterly cash dividends. Very nice. So if you guys buy into this company, congratulations, you're getting an automatic 8% in 2023. Effective for the first quarter of 2023, this is the 27th consecutive year of dividend increases. Note that, okay? Okay, guys, note that, because in Seeking Alpha, they actually have it wrong. Okay, so note that they do have consistently increases dividend for 27 years, so that does make them a dividend aristocrat. And then it continues to say, demonstrating our confidence in the long-term financial health of the company. In addition, the company's board of directors also approved a new normal course issuer bid, NCIB, that permits CN to purchase for cancellation over a 12-month period up to 32 million common shares starting in February 1st, 2023, ending no later than January 31st, 2024. So that's really, really nice, because they're not only are they issuing a dividend, they're also buying back shares. Now, further down here, we do have all of their essentially all of their points, right? Total revenues, we can see that in 2021 it was 3.75 billion, 2022 it was 4.54 billion, and this also itemized pretty nicely as well. Operating income went from 1.56 billion to almost $2 billion. Really, really nice. Net income went from $1.2 billion to $1.42 billion. Again, guys, this is all in Canadian dollars, just letting everybody understand. I'm just saying dollars because it is the, I'm not going to say Canadian dollars every single time. It's just too long. Free cash flow went from $1.26 billion to $1.335 billion. Okay. Dividends per share, you can see it was 62 cents to now 73 cents. So that's really, really nice. And share repurchases. Actually, yeah, they bought back, they actually repurchased a little bit more shares, going from $1.059 billion worth of share repurchases to $1.065 billion in share repurchases. So now coming into the calculator, guys. Now, because this is taken from Google Finance and I am in the United States, this automatically gets changed over to US dollars. So now the calculator is actually going to take everything in US dollars, as well as all of the fundamentals are also in US dollars. Seeking alpha, you could change it to the different currencies, and this also applies to US dollars. So everything you're going to see from now on is now in US dollars. We got the ticker symbol for CNI, market cap of $81.5 billion and a PE of 21.67 with a current share price of $120.78. This on the 1 year, it is down 1.66. It was actually not down a lot. Year to date, it is up 1.35 again. Not up a lot either. 52-week range is $103.79 to $137.19. Looking at this company in the form of a dividend, they do pay out $2.25 in annual dividends per share, which is a yield of 1.88 with a payout ratio of 38.21, a 5-year CAGR of 12.06 with one consecutive year. This is wrong. As I said, they just announced in their earnings report 27. So ignore this 1 year, guys. It's 27. Ex-dividend date is on the 9th of March. Payout date is going to be the 31st of March, and they pay their dividends quarterly. Based off of the current shares outstanding and this $2.25 in annual dividends, they pay out $1.51 billion every single year. And after this is paid out in their 5-year average free cash flow, they're still left with almost $900 million. As of their last year's free cash flow, it is $1.4 billion. So really good to see that their last year's free cash flow is higher, meaning that they're pretty much increasing their free cash flow. These payout ratios, as of the last year's free cash flow, it is 52.2%, which is it's healthy, but it's not like as healthy as it could be, but it's still under 60%. And unfortunately for the 5-year average, it is slightly above 60% at 62.65%. Now looking at the fundamentals, we got 5 years ago of $3.17 billion to 1 year ago of $3.78 billion, increase of 19% with a small dip, guys, 3 years ago. But guys, this was COVID related, so I'm not really gonna blame them for it. Now, you can see that they did dip here to the 1 year ago a little bit. So I'm actually going to change the 75. Now I'm actually thinking about it. I'm going to change the 75 to like an 85%, honestly. Like, I understand as to why they did that, right? So why they went down 3 years ago. So I think that's perfectly fine. Looking now at the free cash flow, we got 5 years ago of $1.75 billion to 1 year ago of almost $3 billion, increase of 65% with an average of $2.41 billion. Now, here actually is a little bit different. 4 years ago, they actually came down. So from 5 to 4, they came down. 3 years ago, where in the net income they came down, well, 3 years ago they actually went up, probably because their capital expenditures went down. So they continued to rise even into 2 years ago, but then they came down a little bit. So for this reason, I'm giving this guys a 65%, mainly because of I have no idea why they went down 4 years ago in their free cash flow. Nonetheless though, 65% is my final grade for this one. Looking now at the revenue, we got 5 years ago of $10.5 billion to 1 year ago of $12.6 billion, increase of 20.43%. You can see that they did go down 3 years ago, again COVID related, and you know, they brought it back up the following year, but it wasn't to the point of 4 years ago at $11.48 billion, right? It was $11.448 billion 2 years ago. But then as of 1 year ago, they did bring it back up to a brand new high. So I'm actually going to change my mind here once again. I'll give it a 70%. I'm going to give it like a 75%, honestly. Looking now at the total assets minus total liabilities, this is actually looking not too shabby. However, they did come down from a peak 2 years ago of almost $18 billion to now $15.79 billion. Why they went down, I don't know, but overall they're still in the positive. So you know what, I'm rethinking a lot of this, because when I first looked at this, I was just like skimming through it, so I just picked a number. Now that I'm actually logically going through it, I'm going to change them. So I'm actually going to give this a 75%. And of course, average total assets, it is $36.43 billion. Average liabilities is $20.65 billion. And doing this difference, we get $15.78 billion. Looking now at the cash flow minus the liabilities, this one's actually not looking too good. You can see at some point they were bringing it back up. For example, 4 to 3 to 2 years ago. But then 1 year ago was their lowest point at negative $18.7 billion. So that's not good, guys. Average cash flow minus the average total liabilities is negative $17.6 $0.37 billion, I'm giving this a 50%. Now looking at the shares outstanding, this one's looking absolutely gorgeous. Consistent increase within the past 5 years, going from 725.3 million shares to 671 million shares. It's a decrease of a little bit less than 7.5% from the 5-year, and from the previous to the current year, that is almost 4.3% decrease. Guys, this is looking absolutely gorgeous. I have to give this a 100%. Not a single year did they issue shares. This deserves a 100%. And lastly, they currently hold in cash and equivalents $242.3 million with an average of $306.45 million. Looking at the weighted grades, we gave the net income 85%, free cash flow 65%, revenue 75%, assets minus liabilities 75%, cash flow minus liabilities 50%, and shares outstanding of 100%. Overall grade of 76%. Not too shabby in my personal opinion. They have to fix their cash flow minus liabilities and of course their cash flow, but it's not too bad overall. 76% is still a really good solid passing grade. So now let's make some assumptions, low, median, high, to see if at $120.78 this is looking like a buy. Let's say a revenue growth of 5, 6, and 7% for these low, median, high assumptions. Now I'm basically getting this revenue from right here. You can see that the forward's estimated at 6%, so I'm pretty much just saying 5, 6, and 7%. For the projected share buyback on the 5-year, we saw that they have been buying back at around 7%, so I went 6, 7, and 8%. Guys, this puts me, not adjusting for debt, a target share price of $60.37 to $66. And adjusting for debt, this comes down. Unfortunately, they have a lot more debt than they do cash on hand, $42.55 to $47.80. Adding margin of safety of 5, 10, and 50%, there's $36.17 to $45.41. So as it currently stands, the current share price, this is looking very expensive. But then again, everything changes based off of your assumptions. So please, once again, have these calculators. They're available for free. Make your own assumptions and see where you lie. However, according to me, with a required rate of return of 10%, this is looking a little bit expensive. And lastly, let's take a look at this dividend. With a $2.25 in annual dividends per share, putting in $5,725, which again, this is based off of the US average income per year. This nets us an annual dividends of $106.66. All in all, Chad, thank you. I guess thank you for telling me to do more Canadian companies. Hopefully this was helpful. And I might do PBA. That's the only other one I know about. They are a midstream oil company in Canada, so maybe I'll do that one in the future. But nonetheless, here is this company's fundamentals, and hopefully this was helpful. Anyways, guys, that pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the new tech sites. Link in the description below. So with that said, peace out, and I will see you all in the next, well, I guess live stream, and of course, earnings report analysis video.